Hello everyone, I am Dr. R.Brinda Shree, Assistant Professor of Commerce, Shada College for Women Autonomous, Salem 16. In this video, we are going to discuss about the topic issue of equity and preference shares in the subject Advanced Corporate Accounting. First, we have to know what is corporate accounting. Accounting is the systematic record of business transactions in order to know the profit and loss account and financial position of the business. Corporate means companies. Therefore, the accounts prepared and maintained by the companies are termed as corporate accounting. What is a company? There are various forms of organization like sole proprietorship, partnership, company. So, in sole proprietorship and partnership, there are a few persons or a single person undertake the business. But a company is a group of persons who are voluntarily joined together in order to achieve some common purpose. Actually, the word company is derived from the Latin word cum and panis. Cum means together and panis means bread. So, the person joined together in order to earn bread is termed as company in olden days. So, nowadays, a company is a voluntary organization formed by a group of persons in order to attain some common goal. Normally, the common objective of a company is to earn profits. Sometimes a company may be organized in order to render service to the people. Let us see the meaning and definition of a company. Company is an artificial person created by law having common seal and perpetual succession. Company is not a real person. It is an artificial person created by law. Hence, it is an artificial person. It cannot sign documents by itself. So, it will sign the documents by the help of a natural person. So, it will appoint a signing authority or the person who will be in charge of the particular company will sign the documents. He or she will sign the documents and affix the seal of the company with its name and logo. That is termed as common seal. The next term is perpetual succession. It means existence forever. According to this feature, man will come and go, but company stands forever. As the artificial person, it will be created by law. Likewise, it will be earned only by the legal proceedings termed as winding up of the company. So, company is a voluntary association of persons in order to attain some common goal with a divisible capital called as shares and limited liability. In case of sole trader and partnership, there will be an unlimited liability. That is, the owner or owners of a business will have to incur the entire liability by themselves. But in case of company, there is a limited liability. That is, the members will be liable only to the amount invested by them in the concern. Next one is definition. According to the Indian Companies Act 1956, Section 3, Subsection 1, Subclass 1, Indian companies are companies formed and registered under the Companies Act. So it implies that all the companies which are registered in Indian Companies Act are the Indian companies and regulated by the Indian Companies Act 1956. If a person wants to start a business, he can procure funds by way of capital and from borrowings. Capital means the fund invested by himself in case of currencies, assets or any other properties, and borrowings means the funds borrowed from friends, relatives and financial institutions like banks. But in case of companies, Indian Companies Act 1956 given the privilege that the companies may collect the funds from the people, that is general public, by means of shares. Share is the part of share capital. The smaller value of the share capital is called shares. It gives the ownership to a person that he is entitled to the share of a particular company. For example, Mr. A. If Mr. A buys a share of Reliance Limited, then he will be a shareholder of the particular company. First, we have the Indian Companies Act 1956. in order to monitor and regulate the Indian companies. Later, the Act was amended many times. Now we are following the Indian Companies Act 2013. According to this Act, shares are defined as under Section 2, subsection 84, a share in the share capital of the company including stock. It is an indivisible unit of capital expressing the ownership relation between the company and the shareholder. So it is clear, share is the part of share capital. Now see the kinds or types of shares. Basically, the shares are classified into three categories, namely equity shares, preference shares and deferred shares. Equity shares. Equity shares are the ordinary shares, and the equity shareholders are treated as the real shareholders and real owners of the company. The features of equity shares are, it is a long-term source, that is, till the winding up of the company, the shareholders are the members of the company. It cannot be redeemable during the lifetime, and the shareholders are having the voting rights. The shareholders are having a share of excess profits of the company and can claim assets of a company. So in short, equity shareholders enjoy the benefit as a owner of a company. Next one is preference shares. The name itself indicates they are having a preferential rights. So here the preferential rights refers to the dividend and the repayment. Yes, the preferential shareholders are having the right over the dividend at the fixed date during the lifetime of the company, and they can claim the repayment of capital on winding up of the company before the equity shareholders. The third category is deferred shares. These shares are also termed as sweat equity shares or founder shares. The shares which are given to the founders or promoters for their hard work or the efforts taken by them in proportion of the company is termed as deferred shares. Next one is kinds of share capital. So we know share capital is the capital raised by the company by means of equity shares or preference shares. Sometimes it will issue the shares of sweat equity, that is the founder shares. Share capital constitutes the basic finance for the company. So it is the major component of the liabilities of a company. It is broadly classified into authorized share capital, issued capital, subscribed capital, called up capital and paid up capital. First one is authorized share capital. So it is the capital which can raise by the company in its lifetime. That is, it is the total capital position of the company. The capital is limited only to the authorized value. It is mentioned in the memorandum of the company as it's a authorized capital. It is also termed as registered capital or nominal capital. It is applicable that the company cannot raise its funds more than the authorized capital. So it is a limited one. Till its lifetime, it can raise the capital which is mentioned in the memorandum of association as an authorized capital. Next thing is issued capital. It is the part of authorized capital. That is, it is the capital which is issued to the people, issued to the general people for subscription. So authorized minus issued capital is unissued. For example, it is mentioned in the memorandum of association that it can raise the capital of 10 lakhs in the lifetime of the company. Then it can issue the capital as 5 lakhs or 8 lakhs. So usually issued capital is less than the authorized capital. So the part of capital which is not issued is called unissued capital. Then the third one is subscribed capital. Issued capital which is actually subscribed by the people. For example, if the company issued 8 lakh shares, then the people applied for 7 lakh shares or 9 lakh shares, the actual subscription by the people is called subscribed capital. If the people applied excessively, then it is called oversubscription. In case of value which is less than the issued value, then it is called undersubscription. The part of capital which is not subscribed by the people is called unsubscribed capital. Next thing is called up capital. It is a part of subscribed capital. Usually, the shares are issued by the company by means of 3 installment values, that is on application, on allotment, on call money. Call money may be a first call, second call and final call. Sometimes the companies can receive a call amount in a single call. So on the basis of application, allotment and call money, the company may call up the capital which are to be paid by the shareholders. The amount which are called up by the company is called called up capital. Reversely, the uncalled amount of the capital is called uncalled capital. The final one is paid up capital. The amount which are actually paid by the shareholders for the shares taken by them is called paid up capital. The amount which are not paid up are called calls in arrears or unpaid capital. Let us see the types of share capital by the following example. Authorized capital is 10 lakhs. So it is the capital which the company can raise till the lifetime. That is, for example, if a company started in the year 2000 and stands forever, then till its lifetime it can get the capital amount from the people up to the value of 10 lakhs. Next one is issued capital. So in the year 2000, it can issue a capital of 2 lakh to the people for subscription. So it is a part of authorized capital. So issued capital is always less than the authorized capital. So that 8 lakhs remaining out of 10 lakhs, 2 lakh is issued. Remaining 8 lakh is unissued capital. It will be issued by the company later. Next thing is subscribed capital. Out of 2 lakhs, people may subscribe for 2 lakhs or even less than 2 lakhs. In case of more than 2 lakhs, the company will return the expectations. So subscribed capital is always less than or equal to 2 lakh. So let us take it as 2 lakhs as subscribed capital. Next one is called up capital. Called up capital is the part of subscribed capital which is called up by the company to ask the shareholders to pay for it. Here it is stated as 1,50,000. The amount which are not called up, it is called uncalled up. So out of 2 lakhs, 1,50,000 is called up and the remaining 50,000 is uncalled. The last one is paid up capital. If the people pay all the amount, that is 1,50,000, then the paid up capital will be 1,50,000. Suppose if any defaulters, non-payers in that list, that non-payment or the defaulting amount is called as calls in arrears. So the amount which are actually paid by the people is called paid up capital. So it may be less than or equal to rupees 1,50,000. So the share capital is divided into authorized capital, issued capital, subscribed capital, called up capital and paid up capital. Yes, next one is kinds of equity shares. Already we discussed equity shares or actual shares or ordinary shares, which implied the shareholders or the real owners of the company. In that we have various types of equity shares. First one is ordinary equity shares, second one is bonus shares, third one is sweat equity shares. So ordinary equity shares, the name itself indicates just a equity shares. So what are the features we discussed as equity shares? The same features also to be studied. Next one is bonus shares. Bonus shares are the shares which are given to the existing equity shareholders. In case of excess profit or in case of any achievement or any upgradation in a company, then the company will issue additional shares to the existing shareholders in the name of bonus. That shares are termed as bonus shares. Then the last one is sweat equity shares. This term also already explained in the types of shares. So sweat equity shares are normally a part of equity shares. This is a normal equity shares which are issued to the farmers or promoters or founders of the company. Next one is specimen journal entries for issue of equity and preference shares. While issuing shares, the company has to maintain its records for that. So, it is compulsory to journalize the transactions. For making journal entries, the issue of shares are divided into application money, allotment money and call money. Let us see one by one. First one is application money. the company issues shares to the people. For example, a company issued 10,000 shares to the public for rupees 10. That 10 rupees is called as value of share. That is the nominal value or face value of shares. On application, that out of 10 rupees, the person has to given the application money. Usually, the application money is a part of share value. The share value is 10 rupees means application money may be 2 rupees or 3 rupees. So, first applying the share, the person has to send the application money along with the application. Further, the entry is bank account data to share application. So, if a person applied for 10 shares, he has to pay the amount of 2 rupees to the 10 shares. That is 10 into 2, 20 rupees. So, bank account data to share application, that value. Then, this share application will be transferred to share capital because the amount will be collected only for the purpose of issue of share capital. So, the application money will be transferred to the share capital. That 20 rupees which are collected from the people as application money will be transferred to share capital. Then the third one is rejection of excess application. In case if we get any excess application, for example, instead of 20 rupees, if we collected 30 rupees, then the 10 rupees will be refunded to the people, refunded to the excess applicant. For that, the entry is share application account data to bank. In some cases, the excess application money cannot be refunded to the excess applicant because it will be adjusted towards allotment. For oversubscription, sometimes the allotment will be on pro rata basis. In that cases, the excess application money will be adjusted towards allotment money which are to be payable by that shareholder. So, for that, the entry is share application account data to share allotment account. The allotment money comprises of face value, that is par, more than the face value, that is premium, and less than the face value, that is discount. For example, if a company issue the share at rupees 10, the nominal value is 10 and it is issued at 10, that is same rate, then it is called issue at par. In some cases, it will issue more than the face value. 10 rupees shares will be issued at rupees 12. Then the excess 2 rupees is called premium. Then the next category is discount, that is less than the face value. 10 rupees shares will be issued at rupees 9. Then the 1 rupee discount is termed as discount. For that also we have to journalize the transactions. In case of normal value, that is par value, the entry is same, that is share allotment account data to share capital. So, the amount which is received by way of bank to share allotment is transferred to share capital as share allotment account data to share capital. But in case of premium, that premium has to be included in credit, that is share allotment account data to share capital to share premium. So, to share premium is always a credit balance. Then the next thing is discount. For discount, it should be debited. The entry is share allotment account data, share discount account data to share capital. So, the allotment money received. So, first we have to write the entry of capital. Then we have to collect the amount from the people. Then the entry is bank account data to share allotment. Here we have to enter the actual amount received from the people by means of allotment. So, in case of application, first we are writing a receipt entry, then only we are going for transfer entry. But for allotment and call money, first we have to write the due entry, then only we have to go for receipt entry. Next one is first call money. For first call money due, the entry is share first call account data to share capital. For collecting the first call money, the entry is bank account data to share first call. In the same way, for final call also, the due entry is share final call account data to share capital account. Then, for a receipt entry, bank account data to share final call. So we discussed the entries for application money, allotment money and the call money. Then the last one is forfeiture and reissue. Forfeiture means in case of any amount not paid by the shareholders, that shares will be get back by the company. That is, the shares are cancelled and the company will get back the shares from the particular default, that is shareholder. So the entry for the forfeiture shares is share capital account data to amount unpaid to forfeit shares. Then these shares are reissued to some other person. Further, the entry is bank account data, forfeited shares account data to share capital. The next one is profit and reissue forfeited shares. So the companies forfeit the shares from the defaulters and reissue to some other person. By that, it will earn some profits. That profits will be transferred to capital reserve. The entry for that profit is forfeited shares account data to capital reserve. In a nutshell, from this video, it is clear what is a company, what are shares, what are the various classification of shares and share capital, how the company issues shares by means of accounting procedures, how it will record the transaction as journal entries. I hope you all understand the concept. Thank you for your patient listening. Thank you.